What if I told you that every time bombs start falling in oil-rich corners of the world, like the current conflict with Iran, the price of crude oil shoots upward, and a tiny group of insiders quietly pockets billions, while the rest of us pay more at the pump for gas, higher grocery bills, and everything in between? Yeah, you heard that right. Oil prices have already jumped more than 15% since the United States and Israeli strikes began in late February 2026. Pushing Brent crude above $85 a barrel and West Texas intermediate above $80, with gasoline now averaging $3.19 a gallon nationwide. If you think these spikes are just bad luck or random market noise and that nobody's getting filthy rich off the chaos, then today we're ripping open the verified money trail, the sarcastic truth about who actually cashes in when supply fears spike the documented winners among the major oil companies, Wall Street hedge funds, and certain producing nations. And the brutal contrast with ordinary families watching their budgets get torched. Stick with me until the very last word. Because the real-time price action, the hedge fund positioning the corporate profit, surges, and the way every new missile, barrage, or disrupted tanker route adds tens of millions more to someone else's pocket, will leave you equal parts enlightened and furious. If you are tired of watching your hard-earned money flow straight into the accounts of the already ultra-wealthy every time Geopolitics heats up, hit that subscribe button right now, turn on notifications so you never miss these deep dives, and drop a comment below telling me exactly how much more you are paying at the pump or the grocery store because of this conflict. Are you seeing higher gas prices in your area or feeling the squeeze on household bills? I read every single comment, and we are building this conversation together as a community that refuses to accept the official story. Welcome to Money's Hidden Past. Rich people lied. We fact-checked. Let us start with the simple mechanics, because understanding who wins requires seeing how fear moves markets faster than any tanker. When conflict erupts in the Middle East, especially around the Strait of Hormuz, the narrow waterway that carries roughly 1/5 of all global oil supply, the immediate reaction is panic. Shippers reroute, insurance costs skyrocket, and buyers scramble to secure barrels before potential disruptions hit. In the current Iran war, that dynamic is playing out in real time. Iranian retaliation has already damaged tankers' forced closures at key facilities, including a major Bahraini refinery, and slowed traffic through the strait to a crawl. The result? Brent crude. The global benchmark has surged more than 15% since the strikes began climbing from around $70 a barrel in late February to over $85 this week. West Texas. Intermediate. The United States benchmark has followed with similar gains. Gasoline prices have jumped 19 cents in a single day in early March, reaching $3.19 nationwide. The biggest one-day increase since the early days of the Russia-Ukraine war. Analysts warn that a prolonged closure or further attacks could push Brent toward $100 or higher. That is not abstract. It is the price you pay when you fill your tank drive to work or buy anything that moves by truck, plane, or ship. The sarcastic beauty of these spikes is that while the pain is broadly shared, the gains are highly concentrated. A small group of players, positioned to benefit from higher prices, rakes in windfalls that ordinary citizens can only dream about. First and foremost come the major international oil companies, the super majors like Exxon, Mobil, Chevron, Shell, and Total Energies. These giants produce and sell oil and refined products all over the world. When the global price rises, their existing production becomes far more valuable almost instantly. Production costs do not rise nearly as fast as the selling price, so the extra revenue flows straight to the bottom line. Look at what happened after Russia invaded Ukraine in 2022. The big five oil companies, Exxon, Mobil, Chevron, Shell, BP, and Total Energies, recorded combined profits of $467 billion in the 4 years that followed, a staggering jump driven by the energy price surge. In 2022 alone, their collective profits more than doubled to $195 billion. The pattern is repeating right now in 2026. Energy stocks have been among the biggest gainers on Wall Street since the Iran conflict escalated. ExxonMobil and Chevron shares jumped in the first days of March as traders bet on sustained higher prices. Refineries outside the war zone also benefit because damaged facilities in the Gulf mean less competition and higher margins on gasoline and diesel. One analysis found that United States liquefied natural gas exporters like Cheniere Energy and Venture Global are on track to earn nearly $1 billion more per week from elevated prices caused by disruptions in Qatar and elsewhere. These companies are not causing the war, but they are perfectly positioned to profit from the fear it creates. Next come the oil-producing countries that stay out of the direct fighting or even benefit from the chaos. The United States is now the world's largest oil exporter, and higher global prices mean bigger revenues for American producers, especially in the shale fields of Texas, North Dakota, and New Mexico. When Middle East supply is threatened, United States barrels become more valuable on the world market. Russia. Another major producer has already increased shipments to China and India at premium prices, taking advantage of the gap left by disrupted Gulf exports. Non-Middle East members of the Organization of the Petroleum Exporting Countries, plus alliance like those in Africa or Latin America, can also ramp up output or sell at higher prices without facing the same risks. Even some Gulf producers that avoid direct hits see windfalls on the barrels they manage to export. The ironic twist is that while Iran and its allies suffer direct damage, the broader price spike rewards producers who can keep the taps open. Higher prices also incentivize everyone from United States shale drillers to Norwegian offshore platforms to squeeze out every last barrel, creating a short-term boom for the industry worldwide. Then there are the Wall Street players, the hedge funds, commodity traders, and speculators who treat oil like a casino chip. These groups do not produce a single barrel, but they bet billions on price movements using futures contracts, options, and other derivatives. In the weeks leading up to the Iran strikes, hedge funds ramped up bullish bets on Brent crude to their highest level in nearly 2 years, according to data from ICE Futures Europe. Net long positions on Brent hit levels not seen since April 2024, while United States West Texas intermediate bets climbed to a 7-month high. When the bombs started falling, those bets paid off handsomely. Every dollar increase in the oil price can generate millions in profits for the right positioned funds. Traders who went long on chaos are now sitting on gains, while the rest of the economy absorbs the pain. This is not conspiracy. It is how commodity markets work. Geopolitical risk creates volatility, and volatility creates opportunity for those with the capital and the information edge to bet correctly. The energy trading desks at major banks and independent hedge funds have been among the biggest winners in every Middle East flare-up from the Gulf War to the 2022 Ukraine invasion. The energetic contrast could not be starker. While these winners count their billions, the average American family feels the pinch in real time. Higher crude prices flow through to gasoline, diesel, jet fuel, and petrochemicals used in plastics, fertilizers, and packaging. A family driving 20,000 miles a year could see an extra $500 to $1,000 annually at the pump if prices remain elevated. Trucking companies pass costs to retailers who pass them to consumers, so grocery bills rise. Airlines add fuel surcharges. Manufacturers raise prices on everyday goods. Inflation that was cooling now faces fresh upward pressure, and the Federal Reserve may have to keep interest rates higher for longer, delaying relief on mortgages and loans. All of this happens while the beneficiaries Exxon, Chevron, Shell, hedge funds, and certain producers quietly post record or near record earnings. In the first week of the current conflict alone, the potential extra profit for United States liquefied natural gas exporters was estimated at nearly $1 billion per week. That is real cash created by war fear, translated into corporate balance sheets and hedge fund bonuses. The pattern repeats with depressing regularity. During the 1991 Gulf War, oil prices spiked, and the majors posted strong gains. After the 2003 Iraq invasion, the same story. The 2022 Russia-Ukraine conflict delivered the biggest windfall in recent memory, with the big 5 supermajors earning $467 billion in profits over 4 years. Now in 2026, the Iran war is delivering another chapter. Brent crude has already climbed from the low 70s to the mid-80s, with analysts warning of $100 oil if disruptions in the Strait of Hormuz persist. Each new strike or tanker attack adds another layer of risk premium and another boost to the winners column. The United States, as the top global exporter, benefits disproportionately because its production is largely insulated from the fighting, yet sells into a global market starved for supply. American chemical manufacturers are also positioned to gain because Middle East disruptions reduce competing output from the region. Critics will argue that these profits are not immoral, just the result of market forces. Higher prices encourage more drilling, more investment, and eventually more supply that brings prices back down. That is true in theory, but the short-term reality is that a small group captures enormous gains while the broader economy and ordinary citizens absorb the costs. Hedge funds do not create the war, but they amplify the price moves and pocket the difference. Oil companies do not start conflicts, but they structure their businesses to thrive when prices rise. Producing nations do not control foreign policy, but they collect the revenue when geopolitics tightens supply. The system is not broken by accident. It is designed to reward those who control the barrels, the contracts, and the capital. As the conflict continues into March 2026, the numbers keep moving. Oil prices have already delivered their biggest weekly gain since the early days of the pandemic. Energy stocks are outperforming the broader market. Hedge fund positioning remains heavily bullish. And every new headline about strikes in Tehran or damaged infrastructure in the Gulf adds another tick upward in the profit column for the insiders. The question is not whether someone is getting rich. The question is whether you're okay continuing to subsidize that wealth with your daily expenses. From the first price spike on the opening weekend of the conflict to the ongoing volatility this week, the Iran war is proving once again that when bombs fall in oil, country fear is the ultimate commodity. Major oil companies see windfall profits. Non-involved producers and exporters cash in. Wall Street bets pay off big. Meanwhile, the rest of us pay more to drive heat our homes and feed our families. This is not a conspiracy theory. It is the documented mechanics of global energy markets during crisis. The rich get richer, not because they caused the war, but because the system is built to reward scarcity and volatility. The next time you fill your tank, remember that every extra dollar you spend is part of a transfer from your wallet to someone else's balance sheet. If this deep dive into who really gets rich when oil prices spike during the Iran war, and how it is already hitting your gas prices, and grocery bills fired you up about exposing the hidden winners in global crises, then do me a favor right now. Smash that like button to let the algorithm know this conversation matters. Share this video with every friend and family member who needs to see where their money is really going, and let us keep fact-checking the stories they do not want told. I will catch you in the next one, where we break down the next layer of this unfolding situation. Until then, stay informed, stay skeptical, and remember that in the world of oil and war, the house almost always wins.